Most people think owning a home free and clear is the finish line. Like the day the mortgage monkey is gone, life just it's so easy, it's smooth sailing. But here's the part nobody talks to first-time homebuyers about in Philly. A lot of homeowners already live here. Paying off your mortgage early can, in fact, save you a fortune, but it can also be the wrong money move depending on who you are, what your rate is, what your cash cushion is, and basically what else you could do with that equity. So today I'm breaking down the honest math. When a cash deal actually makes sense in this market, I'll also be going over 7 real mortgage payoff strategies that shave years off your loan. If you've been asking how to pay off your mortgage faster, whether you should even try or what free and clear really buys you here in Philadelphia, then this video is for you. I've been helping buyers and sellers close deals across Philly and the suburbs since 2012, and I hear the same version of this question every single month. But before we get into it, let's have a little bit of straight talk. If you find these videos helpful, hit that like and subscribe button so you don't miss out on the next video. And if you're in the middle of a purchase or maybe staring at a mortgage statement right now and maybe you want a second set of eyes on what those real numbers could be for your situation, then feel free to reach out. I'm around and I'm always happy to walk you through it. All right, let's get into it. We're going to move real fast on this. Cash and free and clear first. Then we're going to talk about the 7 payoff strategies, and then we're going to talk about equity because owning a home is basically only half the game. Okay, first things first. Buying a house with cash and owning it free and clear, they're not exactly related, but they are in the same conversation. A cash purchase is basically means when you show up and buy the house without a mortgage. There's no lender, there's no appraisal contingency, there's no drama in the same way. You basically just write a check, but there's no underwriting that needs to be done. The underwriter doesn't have to fall in love with your financial file, anything like that. It's also not showing up to settlement with like a suitcase full of Benjamins handcuffed to your wrist where you just like kind of push it across the table and give it to the seller. It's not like that at all. You literally do write a check. It's a certified bank check. You show up with a little certified bank check, hand it to the title company, and that's it. So in a competitive Philly pocket, like think about neighborhoods where there's good listings that get multiple offers. Basically a clean cash offer can win on speed and certainty, even when it's not the absolute highest number on physical paper. So for example, like I just had an offer I wrote yesterday. My offer was $20,000 higher than the cash offer, but the seller took the cash offer anyway because they just didn't want to deal with the fact that my buyer had a mortgage and they didn't want to deal with the underwriter and all of the other things that come with an FHA mortgage. They just said, you know what, I'll take no headaches for less than, even though it's $20,000 less. So cash does speak volumes. Cash is king. That's a phrase for a reason. The key thing here really, I guess the real point I'm really making is that it's not that cash is magically like better. It's just that cash just removes friction. It removes all of those things that could become obstacles during the transaction. But, and this is the part I need you to hear, cash is only smart if the cash wasn't like your whole emergency fund, or it wasn't your whole retirement, or the money you were about to use to repair the roof, or a job, maybe you're at a job gap shortly after you buy the house, or just life being life. Life comes at us all fast sometimes. I have heard some horror stories where people have like drained every dollar in their bank account or their retirement just to say they own a house free and clear, and then like the water heater dies next month and there's no money to fix it. So you have to understand we're in Philly. A lot of our housing stock is older. Yes, the charm is there, but these are 100-year-old homes, a lot of them. So free and clear doesn't actually mean free of costs either. You still have taxes, insurance, maintenance, assessments. The mortgage company or the mortgage monkey can leave, and then the repair monkey and the maintenance monkey can be sitting in your home just chilling on the couch. So you got to keep in mind that those are all things associated with the house, not just your mortgage payment. So let's talk about when buying a house cash actually makes sense. So number one, you still got a lot of reserves after closing. So think months of expenses still in the bank. I'd say 6+ months of expenses still in the bank. Number two, if the free and clear status of the home is worth more to you emotionally or strategically than investing a pile of money or that pile of money somewhere else. And then number three, if you're in a position where you're in a deal where speed and certainty are the reason you will win this house that you actually want. So I've had this happen a lot of times where the buyer has the cash, but they don't want to necessarily buy the house cash. So what they'll do is they'll use the cash, buy the house outright to beat out everybody else, and then they'll refinance and put a mortgage on the property, get all of their cash back out, so then they can go invest it somewhere. So basically the cash was just an acquisition tool just to beat out everybody else. And I think that's a smart move too. So it depends on who you are and what your personal beliefs are, what your financial strategies are. So it's right for some people, not right for others. Okay, so let's start talking about these mortgages a little bit more. So here's what banks are not going to call you and tell you about. The biggest chunk of interest on your 30-year loan, that gets stacked in the front in the early years of your mortgage. Like that's why how you pay off a mortgage faster in years 1 through 5 matters so much more than if it were like year 22. So every extra dollar needs to be pointed at the principal on purpose, and you need to specify that when you pay your principal with your bank. So what you don't want to do is you don't want to assume that when you send in extra money to the bank, assume that the lender knows that's supposed to go to principal, because that's not what they're going to do. They're just going to create a bank account for you and let it sit there. I mean, you have to be very specific. You have to tell them in writing if possible, and then put very specifically like the words, apply this to principal, or principal payment only, or something like that. So let's run like a simple little Philly math problem here, so this isn't like totally abstract. So city side values basically have been hanging around like the mid 200s on average, and a lot of first-time home buyers I work with in the city and near the suburbs are shopping more like 250 to 400. Like that's kind of the range we're in, depending on the neighborhood. So to take a clean example, we'll do $300,000 loan. They're over 30 years. The rate around right now, they're like 6.55%, which is right near where like the national average for a 30-year mortgage is, at least right now in mid-July of 2026. So your principal and interest payments lands near about $1,905 a month. In the early payments, the majority of that check is basically interest. So it's not really principal. So that's the mortgage monkey we're talking about. And that's the monkey we're trying to kick out of the house. So let's talk about 7 different ways we can give that monkey the boot. Basically, we're going to do some strategies that will help you pay that off faster without really stressing you too much. The cool thing about these 7 ways is that you can do one of them, or you can do multiple if you want, depending on your financial position and what you're comfortable with. So number 1, the biweekly payment plan. Instead of paying once a month, you pay half your mortgage payment every 2 weeks. So some months you naturally will make 3 payments, 3 half payments. But over a full year, that actually works out to 26 half payments, which is the same as 13 full payments. So you basically make an extra payment per year. Instead of 12 payments a year, you do 13 without feeling like you wrote this like huge giant bonus check. So on a payment of $1,905, a half is like $953 every 2 weeks. It's basically one of the cleanest set it and forget it ways to pay off a mortgage early. And just to confirm your servicer applies it the way you want and doesn't sit on like partial payments and just sitting in a holding tank, you do have to reach out to your bank and say, this is how I'd like to pay this mortgage. I want this set up on a bi-weekly payment plan applied to principal interest the way a normal payment would, but I want it on a 2-week schedule. You've got to specify that, or else it's just going to sit. The matching principal plan. So basically you pull up your first statement and maybe an early statement and look at how much of the payment went to principal, because your payment, remember, is principal, taxes, interest, and insurance. So look at the part that says principal, whatever that amount is. Then you want to add about that same principal amount on top of your regular payment every month, and then earmark it to principal. Say this is a principal only payment. So early on, the principal is the smaller slice, which makes it kind of weirdly doable, but you're basically doubling how fast you buy back the loan in those heavy interest years. And this is one of my favorites to explain for first-time homebuyers, because the number feels so specific and it's not random. So like if you have let's say $1,000 per month payment, and let's say $100 or $200 goes to principal every month, then you're gonna write a check every month for like $1,200. So you'll write $1,000 for the payment and an extra $200 to principal only, or whatever the amount is. Number 3, you're gonna make an extra payment per quarter. So basically once every 3 months, you throw one extra full payment, principal, interest, taxes, insurance, the whole thing, straight to the principal. Only the principal. You're not making an extra payment for fun, it's going right to principal. You're doing it 4 times a year. So basically it's like a mental seasonal cleanup payment, if you will. So on the $1,905 per month example, that's roughly an extra $1,905 per quarter over a course of a year. And that's pointed directly at the balance. So we're talking almost $8,000 that gets shot right at your principal every year. And that's over 4 years, we're talking almost almost $32,000, which is a big chop at your equity, or a big chop at your loan balance, and increases your equity tremendously. I will say this one's obviously, it's a bigger payment to make the extra mortgage payment like every 3 months. So the people who win with this strategy are the ones who like schedule it into their bills, and they plan for it every quarter. Like, hey, in March, June, September, and December, I'm gonna make this big payment. So if you schedule it ahead of time, people who schedule it will win with this. Okay, number 4. This is a cash influx or windfall. Basically, anytime you get any kind of a large windfall takes place, a financial windfall event takes place in your life, then you apply it directly to principal. So, and some of the examples, I'm like, if you get a tax refund, or if you're in sales, you do a bigger than expected commission. If you get a bonus, a birthday check from a relative, an inheritance, equity from another sale that takes place, or another house you own. First-time homebuyers sometimes get credits and refund windows. They forget to aim at the loan. So just pay attention to possible financial windfalls and be prepared to maybe apply those windfalls, all of or some of them, to your principal balance, because you really want to chop that loan amount down fast. Okay, number 5. We're going to refinance to a 15-year loan. That's one way to do it. Now, there's a couple ways to do this. So obviously, financing to a 15-year loan, you're going to make your payments will now be larger. And obviously, because you're paying off the loan in 15 years rather than 30. For me, what I like to do, because life happens, like if you refinance and went right into a 15-year loan, I don't know if I like this method as much. What I would do though, if this method does appeal to you, I would say keep your 30-year loan, but make payments as if it's 15 years. Because and then make sure that the excess of the payment, so if you're let's say your 30-year payment is $2,000 a month, but if it was 15-year mortgage, it would be like $3,000 a month, then I would say make sure you're sending it to principal only, the excess of the regular. But if, God forbid, life happens and you have now a financial hardship, at least you can pocket the $1,000 per month and still make the regular payments. Because if you actually refinance to a 30-year or a 15-year mortgage, you are going to be required to make that $3,000 per payment, no matter what happens to your life. So I would just say keep the 30-year in place and act as if it's a 15-year loan, and make a payment as if it's a 15-year payment, rather than actually refinance into a 15. Okay, this next one's one of my favorites. Number 6. Basically what you're gonna do is you're gonna divide your mortgage payment by 12. You're gonna take your normal monthly payment, divide it by 12, and then add that little number to your principal payment every single month. So on the $19.05 per month that we've been talking about, that's an extra $159 a month. Feels kind of small, but that's the point. It's a rounding habit. It's over years, that small principal additions in the high interest window are like compound interest in reverse. They're gonna steal future interest before it can really bill you. So if $159 is too tight some months, fine, no big deal. Change it to just like 100 or something. But the habit itself matters more than the perfection. Or if it's the other way, maybe you're feeling great and maybe 159 is a little too low and you can afford to do 200. Do that. The more you do it, the faster it will pay the mortgage down. And I'm not talking like 2 or 3 years. Some of these, if you do these methods right, some of these will take like 7 or 8 years off your mortgage. And number 7, this is just basically kind of a free-for-all kind of one. It's called do what you can. Budget cuts, gatekeeping on the little leaks in the house financially, an extra $100 a month here towards principal on a loan like this does save a real pile of interest over the life of the loan, and then can pull your payoff date in by years, depending on how early you start. So, and I do mean that because people do get stuck because they can't do like the dramatic version where they just pay off everything all at once. So they don't do anything, and that sucks because something does beat nothing every time. Okay, real quick warning about that this does apply to all 7. So I want you guys to tell your lender or your lender servicer to put, and I'm reiterating this because I know I've already said it multiple times. You do have to tell whoever's managing or servicing your loan that any additional payments you make have to be towards principal. You have to be specific. Check the next statement you have and make sure they're actually landing on principal. If it didn't, you need to call and fix it because that's one boring habit. You want to make sure that actually counts. You don't want to be sending in monthly payments and then the bank takes your extra money and is like, oh, they sent us some excess. Whoops, we'll just put it in this bank account for them. No, you don't want it sitting in a bank account doing nothing. You want it applied to principal to take interest away from the bank. You want it you're basically paying yourself. Okay, so let's say you're doing one or multiple of these methods, and you see your balance dropping, and now equity is growing, and maybe you've already bought a home years ago in Philly, and values moved while you slept. So what can you do with the equity in your home? Let's talk about that. The first option is pretty easy, actually. You can do nothing. You can just let it sit. That's stability. That's optionality. That's totally valid. Especially if, I would say, if high interest consumer debt is already gone, and you like safety and you like that thicker equity cushion, no problem with that at all. You just sit there and let your net worth increase with value over time. The second option is a home equity line of credit. Some people say HELOC, H-E-L-O-C. Basically, a home equity line of credit is, think of it like a credit card that's like secured by your house, but usually cheaper than consumer debt, which everything is cheaper than consumer debt. But basically, you only pay interest on what you actually draw out. So people use it for like planned renovations, consolidating like nastier debt the right way, or maybe just bridging a purchase. Maybe you might be using it to acquire a new investment property or something. Basically, your house is on the line though, so you better respect this line of credit you're using. The third option, you can do a cash out refinance. Basically, you replace your current mortgage with a bigger one and pocket the difference. So sometimes it's useful. Sometimes people accidentally reset the clock on a loan where they were winning on to pay a ton of interest all over again. And that's kind of foolish. So you definitely maybe sit down with a financial advisor, run both paths on paper before you sign anything. The fourth option is the longer game family moves, like helping with a down payment. Maybe you could funding a renovation that actually adds value in your specific neighborhood, or maybe not just like a trendy kitchen thing, but maybe something like an addition where maybe you can an in-law suite, or allow family to all live under one roof if you've got kids, if you need help, things like that. The thing here though, I just want to stress that you want to make sure that you're planning this properly financially. Only like real numbers, real reserves, a real plan with the property. Equity is a tool. It's not a personality trait. It's not I would say treat it like fire. It can heat your home or it can burn it down. Don't mess with it. It needs to be respected. So after all that, it loops all the way back to the cash question. Some of you are watching, you guys can buy free and clear today if you want to. Great. Well, that's awesome. Some of you are 18 months into a 30-year loan and you just want to get this mortgage monkey off your back. And some of you should keep the mortgage on purpose because the rate you have right now is extremely manageable and the money is extremely flexible. So grinding the loan to zero tomorrow would kind of leave you cash poor, and that's not really a great thing either, especially if your home's an older one that might need some repairs. But at the end of the day, there's not like any moral prize for the person who can pay off their home the fastest. So just everybody's got their own situation. Analyze your situation and then make the move that's best for you. So let me give you guys some decision framework that you guys can absolutely steal this. So if your mortgage rate is high, you have no high interest credit card debt, and you've got some solid emergency fund, leaning into payoff strategies like 1, 2, 3, 6, and maybe 7, it's usually a strong move. If your rate's lower and you have higher interest debt, like I would say kill the ugly debt first. If cash flow is tight, then do the small version, divide by 12, like an automatic $100 here or there, or windfalls only or something like that. If you're sitting on a large cash pile and fretting about free and clear, then I would say ask one hard question. After I buy, do I sleep at night when the heater dies in January? If the answer is no, keep some of the cash on hand. Paying off your mortgage early it's not a personality, it's a math prioritization. So own the math and the monkey gets lighter either way. So just make sure you're making the right decision for yourself. So there you have it. Cash and free and clear when they help. 7 ways to pay off your mortgage faster when you're financed, and smarter ways to think about equity so your house works for you. If you want help running real payoff numbers on a Philly purchase price or an offer strategy that fits your cash position, then feel free to reach out. You can obviously call or text. All my numbers here at the bottom of the screen. But like I said, feel free to reach out. I'm certainly here and always happy to help you guys. If you found this video helpful, please hit that like and subscribe button for more Philadelphia insights. And please drop a comment. Tell me which of the 7 you're going to be starting on this month. I'm kind of curious to see which ones you guys are going to pick. But for now, I'll see you guys on the next video.